and welcome to Rising. We have a wonderful show planned for you today. I'm Ameshia Cross, and I'm excited to be joined at the desk this Friday by Inez Stepman. Welcome, Inez.
Thank you. So it's great to be here, and it's great to be here with you, Ameshia.
Absolutely. Again, we have such a great show planned, so I know you're going to be extremely ready to get into it. Well, Inez, let's just get right in. New labor numbers are out this morning. The U.S. economy added 253,000 jobs in April. That's a lot of jobs, bringing the nation's unemployment rating down to 3.4%, a really good sign. However, one that likely will not hold for long, according to economists. These numbers come just days after the Feds raised interest rates, another 0.25%, bringing it to the highest it's been in 16 years, just over 5%. This, despite some economists' worries that the U.S. could be heading directly into a recession. This is the 10th consecutive hike in the interest rate since the Fed began raising rates to combat inflation just last year. One economist told ABC he expects the higher rates to cause a spending and hiring downturn in the second half of 2023. Senator Elizabeth Warren expressed her concern about the rising rates on CNBC. Let's watch.
What really troubles me about that is that the pain to come won't be a surprise. It won't even be incidental. Go back and read the Fed report. For example, the Fed report from December, which specifically said their target is to increase unemployment by 1 full point in less than 12 months. Now, what that means is go explain to 2 million people who are going to lose their jobs, people who are making their mortgage payments and their rent payments and their grocery payments right now. Sorry, for the good of the overall economy, you have to lose your jobs. But also look at the rest of it. How many times out of the last 12 times that unemployment has gone up 1 full point in a 12-month period, have we avoided recession?
Zero.
How many times?
Zero.
Zero.
Meanwhile, according to a new Gallup poll, half of Americans say they worry about their money's security in banks in the weeks after several high-profile banks collapsed. This week, Fed Chair Jerome Powell spoke to J.P. Morgan Chase's government-brokered acquisition of First Republic. Let's watch.
I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system.
Okay, so we're going right back to too big to fail, it sounds like. That was my interpretation of what he just said.
History seems to be repeating itself. We watched this, the fear that arose in 2008. And obviously that came about because of the housing crisis. And you had individuals who were basically wanting to put their money under the mattress again during that time as well. Now we are on the brink of, and it's been prognosticated for a while, or at least signaled, that a recession was coming. And I think that when we continue to see inflation, when we continue to see people who cannot afford their rent, who cannot afford their mortgages, who cannot afford basic groceries, things start to get a little scary. And even with these recent job numbers, which do post a certain highlight, Americans seem to not be feeling this at home.
Yeah, and those job numbers came with an increase in the average wages of about 4%, but that's wiped out by inflation. So people are barely, sort of paddling faster to keep their heads just below water. I won't even say above water. Similarly, right, the average American home right now, the average mortgage has gone up by about 50%, in part because of these rate hikes, right? There's a huge difference in the monthly payments that Americans are going to have to make. All of that is just waiting to collapse if that job market starts to fall apart in a recession. Then you really have problems. People are, even though the job market is tight and the labor market is doing well right now, as soon as that drops out, there's going to be a huge amount of pain for the average American family. And I really, these numbers, I don't think are anything to celebrate. Unfortunately, I wish they were.
We also have to be really, and I like the fact that you brought up that even though certain wages have gone up, that is not necessarily meeting the cost of inflation. People aren't feeling that. But in addition to that, we have so many jobs that are available, but these aren't necessarily the types of jobs that provide a living wage for a lot of people. And living wage today means something different than it did 5, 6, 7 years ago.
It means something different than it did a year ago.
Exactly. So you have people who are trying to figure out ways to get into various career sectors that allow for them to be able to literally feed their families. And it becomes a lot harder because a lot of the jobs that have been expanded or the jobs that are available now are jobs within the restaurant industry, jobs within the retail industry, jobs that are typically not the ones that are to sustain a livelihood and household.
Yeah, no, I think that's very true, and I just think across the board, though, it's not just going to be in these particular sectors. I mean, the media sector and advertising sectors have taken huge hits. I don't mean like media folks like us. I mean like as a sector, and there's been huge hits across the board in a lot of different industries. Not to mention tech. I'm from Silicon Valley. I know that there is a sort of mini tech recession. It's more difficult to get a job, and again, this is all going to get much worse as soon as that bargaining power, because we have a tight labor market, goes away for workers. It's going to get much worse. Right now, you still have that ace in your back pocket. You can still switch jobs because there are, even if they're not your ideal job, even if you actually are in a position to negotiate what is something closer to your ideal job, even with all of these bad economic numbers, the inflation, the price of eggs, as everyone keeps talking about, right? But that's still, fundamentally, at least you can kind of shop yourself around and try to improve your financial situation in your job right now. Once this recession, and I've heard the same things, and it's all across the news, this is not something that's not predictable. Once this recession likely hits in the next few months, that position for a lot of people is going to go from bad to worse.
And there are two things that are on the horizon that we have not talked about. One is the payment pause, the student debt repayment pause is going to end in the next few weeks. So when those student debt payments are back and people have to add this other bill to the slew of things that they're already paying, we're going to see another layer of people, again, trying to keep their heads above water, in addition to facing these high rents that aren't going away, and the fact that a lot of Americans right now are essentially paying their bills and living off of credit. So while we're watching these inflation numbers not be where we would like for them to be at this point, irrespective to the changes in interest rates, we're also watching people continue to buy against credit because they quite frankly don't have anything else that they can do.
Well, and those interest rates affect the credit card interest rates as well. So this is a delicate house of cards, and it's not just for the American worker. I don't want to leave out the conversation about the banks here, right? So we've had some very high profile, the second largest bank failure in history, right? And everyone's kind of saying, oh, it's going to be okay, it's going to be okay, it's going to be okay. And they're selling these banks, a government brokered acquisition, as we said in the intro to this segment, right? We are selling these banks to larger banks, but all of these assets are maybe not as bad as it was in 2008. There doesn't seem to be the same sort of collapse and bad mortgages, for example, that happened. So it won't be history exactly repeating itself, but there are other underlying problems with some of the assets of these banks that are going to be made much worse by increasing the Fed continuing to increase interest rates, which they have signaled in this latest batch that they may be pausing that. They have increased it by a quarter point again, but they omitted a final sentence. Everything here is very obviously, every sentence, every period is scrutinized from some of these statements that the Federal Reserve gives out, but they omitted a final sentence that they had put on before, basically warning people about further interest rate hikes. They've kind of signaled that they're going to pause here while still hiking a further quarter point.
And they had to because, again, back to 2008, taking on the debt of other banks also is not always in the best interest of the bigger banks. We saw that happen when a lot of the banks, especially in urban communities, took on several black banks, several smaller banks who had given out mortgages, who had given out lending to small businesses and other things. Some of those were risky to begin with, and what that meant for those banks as well, because it's very hard to flip those things back. And those communities were still suffering. So I think that while we look at this and we see that, there are more, it seems like every other day we're hearing about another bank that may be on the brink of collapse, or there's some risky business going on. I can fully understand why Americans are afraid, why Americans are nervous, why Americans are going to credit unions, why they're trying to diversify where their money is, investing in these more what they consider lucid versions of where their money can go, and trying to fully understand this environment that we're in right now that looks reminiscent of 08. I don't want to, signal alarm. It's definitely not anywhere near where we were then.
There are key differences.
But there are the fear is still mounting.
Yeah. Well, and let's not forget the political fallout of 2008, right? And I don't think a lot of people remember this because they focus on sort of the control of debt, of government debt, that became a focus of the Tea Party later. The Tea Party was launched by bank bailouts as well. So was Occupy Wall Street. The idea that we're going to socialize risk but privatize profits. I'm a free marketer, but that's not the free market. If you bet big, you have to be willing to lose big, and the government has to be willing to let that happen. And the really bad precedent that I think is being set here is that even if you're not, quote unquote, too big to fail, right? These are medium-sized banks that are failing. And the reason they were exempt from certain regulations and reporting to begin with was allegedly because they don't threaten the whole system, right? If they went down. But if we're not willing to let smaller banks go down, we're definitely not going to be willing to let, JP Morgan go down. And that, I think, is going to launch further a populist movement that I think rightly, on left and right, believes that there are a different set of rules for people who are wealthy, connected, and powerful to play in politics than there is for the average American, because there's no bank bailout if you can't pay your credit card bill.
And you know what, Inez? I actually 100% agree with you, so we're going to leave it right there. More Rising coming up next.